Hello and welcome to Gold and Silver Assets. This is the horror show edition. So I've put a rating here for this show. So for those who aren't quite up to it, skip straight to the market report. Now, I'm not sure if you can hear any background noise, but if you do, it actually sounds like a chainsaw massacre. There's nothing I can do about it other than perhaps join in. Anyway, why have I called this the horror show edition? Well, it's not just because it's Halloween. In fact, Halloween came a little bit early for me over here. I learned of something pretty horrific that made my blood chill, and I wouldn't have believed it if I hadn't seen it with my own eyes. And I can honestly say this is the most frightened I've ever been in my whole life. And I'm actually extremely concerned, not just for myself, but for each and every one of you. Now, unfortunately, I'm not at liberty to discuss it further. So instead, we're going to look at some things that are, believe it or not, a lot less frightening, but nevertheless scary. One of our viewers recently discussed with me his ideas about the role of a decrease in the workforce adding momentum to inflation. Now, if you think about it, inflation is basically more currency chasing fewer goods and services. If there was no money printing at all, but fewer goods and services, then actually inflation would occur. So that brings us to this chart, which shows the number of people who have quit their job in the USA. We can see that the blue line here shows the numbers that quit, and that's basically gradually increased over the past decade. So over here, you just saw this steady, constant rise. Then we saw this massive drop in 2020. But from the looks of this started very early in 2020. It looks like probably January 2020. But then 2 or 3 months later, we saw this massive rebound back up here. And actually, it's hit record levels, over 4 million. So why is this happening? One theory is that the most recent rise is because of stimulus checks, which basically discourage people from working. But I don't think that's the whole story. And if you look at data from other countries that didn't have stimulus checks, and, in some countries, they had what's called wage subsidies. So you still had to be in work, not quitting, to get that. In those countries, they actually show the same chart, the same trend. Now, another factor that's becoming increasingly common is being pushed into quitting as a result of deteriorating conditions, or even, in some cases, working conditions are becoming dangerous and unmanageable, but also being forced to comply with various regulations. And look, there are many examples of people like me who have had 25 years of training and experience just flush down the toilet. I actually really enjoy working, but sadly, it's just become impossible for me to do so in my current profession. But I don't think that's still the whole explanation. So here on this chart, what I've added is in red, the total household assets. Now, isn't it interesting how they seem to pretty much move in lockstep here? To me, this suggests that as asset prices rise, more and more people feel more comfortable and able to quit jobs that they don't like. Now, this, of course, can lead to a kind of vicious cycle. So money printing, of course, is what has led to these increased asset prices. And that allows more people to feel able or comfortable to quit their jobs because they think that they can rely on those rising asset prices to continue. But then, of course, that leads to fewer goods and services, which results in inflation, which results in higher asset prices. And I think it's only when that inflation actually hits the consumer that this will become a problem. Now, there's also another problem with this, which I'll get back to later in this segment of the show. It's interesting because the Federal Reserve website actually separates out the figures for quits into different work sectors, and I had a look through them, and all of them showed pretty much the same rise in quits since 2020, except for this one. Yes, fewer government employees are quitting in the past year. I thought that was quite an interesting observation there. Here's another scary chart. As well as asset prices going up, household debt levels have also increased, and the income to debt ratio is currently at record levels. How on earth could things have got this far? Over here, the household debt to income ratio is about 165% right now. Well, anyway, how could things have got this far? Well, that's quite an easy question to answer. It's all because of low interest rates. The lower the interest rate, the greater the amount of debt that can be serviced. So on this chart, the green line shows the interest rate over here, and in red shows the cost of servicing the debt as a percentage of disposable income. The big question here is, at what interest rate does the cost of servicing become unmanageable for households? What is the tipping point going to be? Now, it's not just interest rates that's going to be the factor here. Of course, cost of living. So if we get inflation for the consumer that becomes unmanageable, that could tip this over the edge. But also, specific to properties, there are things that are being done. So, for example, in the UK, they're adding onerous regulations like you have to have a house that's green compliant in order to be able to sell it, basically, because the mortgage lenders won't lend against a house that isn't compliant. And of course, in the UK, a lot of the houses are pretty old there, so that's going to cost an arm and a leg. Also, the other trick that can be pulled is property taxes. Now, I heard something, and I'm not sure if it's true, so if we've got anyone from Greece that can confirm this or not, but I heard a story how in Greece, back in the GFC, property taxes went up by 7 times. Now, I get the feeling property taxes are going to go up. Certainly here it's highly likely next year. So I think there are multiple kind of factors that are going to affect the housing market. Now, this is a chart of the overnight reverse repo, and I've tried really hard to understand the mechanism and implications of the overnight reverse repo, and I still don't quite get it. It's not an easy topic to understand, but overall my impression is that this is aimed at avoiding negative interest rates in the USA. But the problem is I'm not sure what the repercussions of doing this are. All I know is that this looks really abnormal, and so I doubt the repercussions will be pretty. That's why I think this is a scary chart. Steel is very important for industry and features in the book Atlas Shrugged. So for the past decade, as you can see here, steel has been in a trading range, trading sideways really between 400 and 900. But look at this amazing string of green candles at the end there. And steel prices have more than tripled over the space of a year. Now, I don't think that the knock-on effects of this have been felt yet. I actually think there's going to be a lag before it hits us. And that's the thing with these rises in all these commodities. Although people are noticing increased food prices, I don't think we've actually seen the full force of the knock-on effect of what we're seeing on these charts. I think that's to come. And isn't this a whopper of a move? The UK natural gas price went up 50 times in under 18 months. Wow. So this is really scary because energy is the lifeblood of the economy. And this has serious repercussions throughout the economy. That's scary stuff. The black line on this chart represents the M2 money supply. And as we all know, it's been rising exponentially. The red line shows something that's barely existed in the 60s and 70s, and it started to rise in the 90s, but really gathered pace in the 2000s. And in the past 18 months, it's gone pretty vertical. The correlation coefficient at the bottom shows that this is perfectly correlated to money supply. So what's the red line? Well, I reckon it's the number of Karens in society. Now everyone's going to have a slightly different definition of what a Karen is, so I'm just going to tell you what my definition is. And that refers to someone who is entitled, selfish, self-serving, and always takes every opportunity to complain about the most minor things. They tend to be pushy and completely lacking in empathy. They lack a sense of humour and are not only miserable people, but they also try to inflict their misery on other people. They come in all genders and races, and I think they're the product of a fiat society. I can't stand these fiat scumbags, I really can't. What's the grey line? Well, that represents the number of people in society who are able to think critically and think for themselves. Now, this has got nothing to do with IQ, which I think is a complete con anyway, and it certainly doesn't relate to the number of letters someone has after their name. Yet another con. We seem to be living in a time where the majority of people have outsourced their thinking, and that to me is very scary. All of these things seem to have led to what I believe is a mass psychotic event. And I'm losing hope of a return to sanity. I hope we do return to sanity soon, please. And finally, we come to a chart that may seem quite basic at first, but I think it has very deep meaning for many aspects of our lives. This is the Thanksgiving turkey problem, or for the Brits out there, the Christmas turkey problem. I learned of this from Nassim Taleb's book, Black Swan. So this turkey was fed very nicely every day. So you got a lovely turkey here. It started off as a little tiny baby turkey here. It fed every day and it was just flourishing, enjoying life, enjoying its meals. And as these days passed, the stronger the turkey's belief that its best interests were being looked after. So the turkey basically all this time believed that it would be fed and looked after for its whole life, forever. Of course, just before Thanksgiving, something completely unexpected happened to the turkey, and that incurred a revision of belief. Let's think back to that chart of job quits and asset prices. So in Australasia, property prices have been pretty much continually going up for 30 years. And just like the turkey, many believe that this will never change. In fact, many of those that quit might be relying on, income from rental incomes or living off the equity from their houses, and projecting those past returns forwards. Now, my concern is that the rug gets pulled out from underneath us, potentially in a very nasty way that could be devastating. Half the battle is just considering this as a serious possibility. Now, I'm sure that this turkey never considered Thanksgiving as a possibility. This is why diversification is so important. However profitable something might be, being all in on one asset risks this turkey problem. And I guess the same could be said about careers as well. I have had some people comment that I'm too doom and gloom. But look, I prefer to call it balanced and realistic. I think that being afraid is important because it shows an acknowledgement of risk. In fact, I think we're living in a very dangerous time right now. I think we're heading into something none of us have ever experienced before, and it will incur a revision of belief. I have reason to believe that not only should we be afraid, but we should be very afraid. And I'm not just talking about finance. Now more than ever, it's crucial that you use common sense and think for yourself. Don't just go along with the crowd without thinking for yourself. As we all know, the crowd is always wrong when emotions are high. I've come to realise that having a plan B is not enough. We need plans B, C, D, E, and so on. I don't believe we can accurately predict the future. But what we can do is consider the possibilities and prepare accordingly. Next up, the market update. Well, not a lot's changed, so not a lot to say this week, so I'll make it short and sweet. We'll start with gold priced in US dollars on the daily scale. And yeah, we got a little bit of a pullback as we talked about last week. I think there's still a little bit more juice in there, so a little bit more downside, possibly to 1760, because we do have a little bit of support there. Basically, we're just waiting. We're still sideways, and ideally we want to get to the 1840 level, really, above there, before we can start getting excitement in any form. So yeah, we're just waiting for it to pick a direction. But look, like I said, that this turn here has taken a long time, but to me it does look like a turn, if you see here. Anyway, I'm still bullish. I know it annoys some people when I say that, but hey. Silver priced in US dollars on the daily scale, and again looking quite positive, and we got that little pullback. I think again a bit more downside there. Could even go as far as retesting this channel again. Hard to say, but yeah, that is a possibility. This bit here could act as a bit of support though, and the 23 level has been reasonable over there as well. So possibly something like this, I'm thinking. And then the GDX, and so this is on the daily scale, and we actually gapped down here. So obviously the miners basically dropped a lot more than the metal itself, and we were talking about this gap in last week's show. I still think that's going to be filled or attempt to be filled, so again a little bit more downside. But the good news is we've got a lot more gaps above. We've got one here, big one there, and another one over there. So yeah, just a little bit further to drop before I think if we do something like this, then we've got this inverse head and shoulders over here, and that would give us a target of up into the high 30s, basically 39, possibly even 40. And finally, we've got the silver junior miners, SILJ, and a similar story, you see. So again, we've got the gap over here. So this has actually got a bit further to fall down here, over here. So yeah, that's what I'm thinking. And again, we've got that kind of balance over here. And this would kind of bring it to, you know, at least 50% of retracement of this rise here. And so, yeah, potentially we could take off from that point. Anyway, for those of you who missed last week I went through a lot more in terms of indicators and things like that. Nothing's really changed since last week, not a huge amount. So not much to say, I'm afraid. Now, I've noticed that quite a few YouTube creators have had their channels randomly deleted. Look, I don't know if talking about gold is an offence yet. Could be though, anything's possible these days. And so just in case, I've also got my channel on Odysee. And so the videos come up there exactly the same as they're over here. Now, I mean, I was actually at one point thinking of just going on to Odysee. The problem there is that the commenting system doesn't seem great because I don't see a way of how I can reply to comments. So, you know, I've had a couple of people write some nice comments there in the past, but I've not been able to reply to them. I don't know if they've set that up or am I missing something, if anyone knows. So anyway, but that is an option there. So just in case. All right, then. That's all for today. See you next week. Bye.